As we come to this week's risk events, it's growth, inflation, and consumer expectations that are going to be driving markets most likely this week. But I just wanted to give a little heads up that with so much uncertainty regarding the US administration and the implication of
Just wait a minute
tariffs,
now. I need something.
they're on, they're off, they're on, they're off. They're 20%, they're 25%. This constant chopping and changing means that markets are likely to be very volatile. So just make sure that you're dropping into the risk events so we can see what the sentiment is actually at the time of the risk event. Because with so much change and so much uncertainty regarding the actual path of the US administration, just bear that in mind with risk events this week. Everything will be covered live at the time, and we'll be going into the actual market conditions that are in place while the risk event is breaking. So just be aware of that uncertainty that we've got coming up this week. As we come to this week, the first event to really be looking out for is the US inflation data that we have on Wednesday. Inflation remains in focus for the US, particularly with relation to the speed of interest rate cuts. And although markets have been pricing in 2+ interest rate cuts at the time of making this video, the market will be surprised by a hotter than expected CPI print, and that could allow the dollar to strengthen a little bit, and that could push back against some of these calls for sooner interest rate cuts and can actually weigh a little bit further on equity markets. So we'll analyse the data and exactly the market conditions nearer the time. There's quite a few moving parts at the moment, and it isn't making it easier with tariffs switching on and off every couple of days seemingly. So sentiment will be very important at the time. However, a higher than expected print should be positive for the dollar, should be negative for equities, and a lower than expected print should allow the euro dollar pair to particularly surge higher, but we will confirm that nearer the time. But US CPI remains in focus. It's clearly a risk event not to miss, and one we'll be looking forward to. And don't forget, we've got the Fed's dot plot coming the week after, so will be important in terms of expectations for that Federal Reserve interest rate meeting. Currently, markets are expecting the rate to be down at 3.61% for December. So we've seen a gentle pricing in of more cuts over the last few days, really, and a lot of that is due to concerns over the US losing its advantage due to these tariffs punitively impacting the US GDP expectations. We'll see if we start seeing this translate into the hard data, what impact it has. But for now, it's mainly been soft data. But anyway, we'll cover that again near the time. The UK GDP print is another one that's going to be important because, similar to the US, the UK is trying to balance inflation expectations on one hand, but also growth expectations on the other. And we saw that very clearly come out in the last Bank of England meeting in February, where on February the 6th, we saw Catherine Mann, you can see her at the top of the Monetary Policy Committee voting history. She voted for a 50 basis point rate cut, whereas the rest of the members, that were voting for a cut, apart from Dingra, were voting for just 25 basis point cut. There was a cut in the end from 4.75 down to 4.50, but you can see, that it was Dingra and Mann who surprised with a 50 basis point interest rate expectation. Everyone else was expecting a cut of 25 basis points. Now that's quite unusual because Mann's typically been quite hawkish. So she was citing growth worries and growth concerns as part of the reason for her decision. So what that means is if we do see a bigger than expected miss in the UK GDP print, then that could easily start tilting the argument in favour of Catherine Mann, and that we might see greater expectations of interest rate cuts coming the week after from the Bank of England, one not to miss. Then we have the University of Michigan consumer sentiment. Now, we had, I think it's Feds Williams saying, take a look at this data. And it was particularly the inflation expectations that got markets attention, with the 1 year, the 5 year inflation expectations, really ticking up significantly higher, multi-year highs. That will worry the Fed. if consumers are just seeing, a lot of inflation ahead. So this could move markets, particularly the 1 and the 5-year inflation expectations we'll be looking at. But the slight caveat is I did notice there was a party split on the votes. So with the 1-year inflation expectations, those Republican voters saw little to no inflation, whereas Democrat voters saw significant inflation. So there was quite a political skew to that consumer sentiment data. Nevertheless, if we see that coming in again, sentiment negative, 1-year, 5-year inflation expectations pushing higher, then we could easily see sharp selling in the S&P 500 E-mini, definitely one for us to look at. So that's what we've got coming up for the following week.